Well, it's great to have you with us. Hope you had a wonderful weekend. And as we gear up for another week of September activity, two things hold true. Number one, when it comes to stocks, they're hovering around all-time highs. Number two, the economic story in both Canada and the U.S. is starting to show more signs of weakness. So let's get some insight and analysis on how you should think about what that means for your portfolio. Richard Croft is Chief Investment Officer of Croft Financial Group and one of our regular guests. Richard, it's great to have you with us. Maybe for those who are watching signs of a cooling economy, yet a stock market that remains at all-time highs, what's your assessment of that?
You know, it's a tough thing to figure out. Good to see you, John, by the way. It is a tough thing to figure out because the market is sort of walking through this with a meh attitude. And I suspect, and there's been a lot of back and forth between analysts in terms of what's causing that, but the one that seems to resonate most with me is that the earnings have been so stellar in this last quarter. They've been very good. And the market is basically ignoring everything else that seems to be going on in the background and relying very much on what's going on in the front row center, which is strong earnings. We saw a lot of it, and the other thing that's going on too is I think in the technology front, you're getting, of course, artificial intelligence is a big play there. That's not all that different than what we saw in the 90s when the internet was going strong. They seem to ignore a lot of things that were going on in the background in terms of higher taxes and so forth. That was under the Clinton administration, which, by the way, was the last time the U.S. had a balanced budget. So I'm not sure. I think at some point, the other issue that you would look at and think about is the boiling frog analogy, where we're just, as water is warm at the beginning, it seems very nice. And then all of a sudden you get that exponential kick in the value in the heat, and you get a catastrophic result. So that would be the thing I would worry about, and I think that's why gold's doing as well, among other things.
It really has had a tremendous run, and Bloomberg had some analysis that gold stocks make up more than 10% of the TSX, and I think at least half of the top 10 contributors to the TSX rally this year are gold-related stocks. I do want to ask you a quick question about interest rates, because obviously one of the factors that has continued to fuel gold is this belief that interest rates are coming down. We always look at rate policy and stock market expectations around it. I've heard a lot of people say that this idea that the Fed is now leaning more significantly towards rate cuts has further amplified the move into stocks. But of course, the rate at which the Fed might have to cut, depending on the economy, is something that we also have to pay attention to. So how do you think about rate cuts and stock prices?
Well, rate cuts would normally be positive for the stock market. The idea behind a rate cut at this point, it would depend on how significant the rate cut is. If the Fed were to follow along the thinking of the White House administration, it would like to see a 300 basis point cut in overnight interest rates. That would have a negative effect on the economy and would be seen as inflationary in the bond market. Bond yields would rise at the points in the yield curve which impact consumers, and the stock market would decline. If we're getting a minor cut, 25 basis points seems to be the prevailing wisdom at this point, that would suggest that the Fed is maybe a tad behind the curve, is maybe a little bit above the neutral rate, and they're easing their way back to that. I don't think that would be bad. I don't think that in and of itself is going to drive stock prices higher, significantly higher from here, because I think a lot of what's driving the market right now is in the technology front, which doesn't really have much impact on interest rates anyways, because they're hoarding for cash. So
fair point. Okay, so with all that said, really helpful macro analysis. Richard, how are you thinking about portfolio strategy these days?
Well, one of the things is if you get a cut in rates and it's a minor cut, and I think best case we'll get 2 this year, so that's kind of where I think we're going. I also could I think there's a decent probability we could just get 1 and that'd be the end of it. We'll wait and see. I do think there is a case to be made that the Fed is slightly behind the yield curve. They are slightly behind the curve in terms of their objectives of keeping the economy strong, jobs market strong, and so forth and so on. So that said, I think that in portfolio strategies, we tend to be having some preferred shares in the accounts because preferred shares are yielding significant, about 2 percentage points higher than bonds of the same corporation. And I think if they're quality preferred, I don't think that risk premium is justified. Secondly, I think you want to look at some tech. You want to stay in tech at this point. I think it's going to be a defensive position as we move forward. Financials will do well in that yield curve analogy I talked about, and hence you're seeing that in the Canadian banks. You certainly at this point want to have some gold, and that's played out quite well so far as well.
Okay, helpful context. Richard, great to see you. Appreciate the breakdown.
Thanks.
Richard Croft, CIO of Croft Financial Group.